All right, everybody, it is time. Thanks for coming today. Thanks for taking the time out of your day to do this. Some of you may have more than enough time with the COVID-19 issue going on right now and are just super happy to be here. Others of you had to carve time out. I really do appreciate that. I'm excited for what we're going to share today. I'm Nate Scott. You may have heard me from the Dollars and Nonsense podcast or on the beginner's course. But one of my favorite things to do is teach, and that's really what we're going to be doing today. A couple of things, the ground rules here, as I just mentioned previously, we don't have the audio on for those of you. In other words, I'm the only one allowed to talk. At the very end of this webinar, I'll open up just a few minutes for question and answers. I do value your time. I value my time, so I don't plan on keeping us here for very long. I'm going to try to fly through this. I talk fast. I've got some things I want to share. One of my least favorite things is hopping on a webinar and being there for who knows how long. Just a preface to kind of set us right, I wanted to mention what we're going to go over today. And honestly, as you may find out, I'm kind of doing something today that I don't normally do. So take advantage of it. And there's a reason that I don't do that. But one of the things, with everybody worried about the stock market right now, it seemed like an opportune time to talk about some of the things we always talk about, but just to kind of reinforce it. And so we wanted to, you may have heard things like buy term and invest the difference, or whole life insurance isn't a great place for money. And we've heard all of these different things from various individuals, whether it's Dave Ramsey or Susie Orman and things like that. And so we're going to spend some time today showing exactly what that is. At the very start, I wanted to share briefly how we design policies. That's how we're going to start it, because how you design a policy is really important. That's kind of the foundation. It's not an exhaustive course on how to design a policy, but it at least gets us all the same background for what we're going to do next, which is kind of the crux of what we're doing today is something that I don't do. I'm kind of conceding something. And that is we're going to build up to actually pulling up a real policy, showing you how that policy is going to grow over time, and actually comparing that to, let's say, like a stock market, like a mutual fund asset or something like that, how much you'd actually have to earn outside of a policy just to match what the policy is giving to you. And the reason why I say it's not something I normally do, the reason I'm kind of conceding a little bit is because one of the things, if you've followed us for any period of time, you know that we do this thing called infinite banking, and it uses these whole life insurance policies. And we don't really want individuals to believe and see their policy as an investment. That is, if you've been wondering, that's actually one of the reasons why you don't see Living Wealth or Nate Scott or any of us comparing policies to other investments very often. And the reason we don't do that is because we actually encourage people to use their policies to make investments. And we don't really want people to see the policy as an investment, but as a banking tool. That's really what we're trying to do. And this life insurance policy can be used to make other investments and actually make them more profitable. And to give you a little sneak peek, next week, I'm actually going to dive into that subject as well. Actually, next Tuesday, I'm going to be doing another webinar just like this, where we talk more specifically just about how to use your policy to make investments, how to do it properly, and how it can increase your rate of return. Just as a snapshot, just see, hey, if I have a policy and it's growing and I leverage that to go buy another asset that's growing, I can have two, and then we'll show you how exactly that works, how you can actually make more money. So just to give you guys all a background, that's actually why we don't normally compare them. So the reason I am comparing them today is because mainly I just wanted to give some of you encouragement, is actually what I wanted to do, or reinforcement or something. So for me personally, I don't invest money in the market. The only time I would put money in the market is if I'm going to do it for a short-term time frame, because I think that at the bottom of a big sell-off would dive in, similar to like what's happening right now. You see a lot of people buying in now, but that's why I use policy money and I build it up, and I see opportunities, not just the stock market, but I see opportunities. But I guess what I'm trying to say is to give people encouragement that you don't have, if you see the power of the policy and you see how it's going to be growing, you may come to believe that you don't need to be in the stock market. You don't need to earn a high enough rate of return to do things. That's actually the main reason why we're meeting today, is to show you the true power of the policy, a little bit of how it compares, but as a main goal of saying, hey, maybe you should rethink whether or not you really want to be there. Because a lot of time it just adds a lot of emotional distress. and just anxiety to be in the stock market. And people are just in there because they think they have to be to earn enough interest or return to be able to retire someday or whatever it is. This is mainly an encouragement to say maybe you could rethink that. I'm not saying you shouldn't invest money. I'm not saying the policy is an investment. In fact, I'm not even allowed to say that for regulation because it's not an investment. But I am going to say that maybe I can encourage you that you don't need to be there. So that's why I'm doing it today. And then next week, we're going to dive into more detail on how you can use a policy to make investments. And then if you combine that with this, you can have a pretty good idea of what we're trying to get at. So with that, as I said, and I respect your time. We're going to dive right in. If I go too fast, you'll have to survive. So we're gonna jump right in. So as I said at the very beginning, what I wanted to lay the foundation of is how we build policies, how you should build a policy for infinite banking. At least just a brief history, brief overview of that. Because as I said, some people have heard, whole life insurance is not a good place to put money from some talking heads somewhere. And they may just not understand how to build it or especially not how to use it. So what I'm going to do here, if you look at the screen, I'm going to go ahead and draw out kind of a timeline of sorts. And you can build a policy anywhere on this timeline whenever you really get down to it. And on this timeline, the further right you go onto the timeline, the higher the death benefit is going to be. And the further on the left side you go, the higher the cash value will be. So if we were to go out and say, hey, Nate, I want to start a policy. I'm going to put in $10,000 a year into a policy or into some, into an infinite banking policy. We can design a policy using that money, $10,000 per year contribution, and put it anywhere we want to on this timeline. If we go way to the right-hand side of this timeline, then we're going to have what's called term insurance. Term insurance, and most of us know that, it's pure death benefit insurance, no cash value whatsoever. So obviously, that's the best way to get a death benefit. It's the worst way to get cash value, but it's the best way to get a high death benefit. In fact, I mean, if you were going to put $10,000 a year into a term policy, you'd have like $20 million of term insurance or something crazy. So you don't see that happening very much, but you could certainly do that if you wanted to. The same thing goes if we put all 10,000 to the far left side of the timeline. This would be called maybe like a single premium policy way over here. You don't see too much of that anymore, but essentially you could just write a check for $10,000 and it would pretty much purchase $10,000 worth of cash value, or at least really close to it, and very little death benefit. So the same amount of money going into life insurance, one side, a lot of death benefit, no cash, the other side, a lot of cash value, very little death benefit. So when you're doing infinite banking, the death benefit we really don't care about. So whenever you design a policy for infinite banking, obviously you want to get as far left as you possibly can. However, there is a line in the sand somewhere over here, kind of near the left-hand side. And the IRS likes to come in and mess with people whenever they're having a lot of fun. And a lot of people were having a lot of fun in the world of life insurance policies because life insurance policies grow without tax. They're tax deferred. And when used properly, they're tax-free. They can be used now and in the future tax-free. So many people, especially back in the 70s and 80s, were putting millions of dollars into single premium life insurance and just living off of policy loans tax-free. And the IRS was essentially saying, you're not doing this for insurance. You're doing this as an investment. And so we're going to tax it. And they defined something. They put a line in the sand. They said that anything that crosses this line in the sand over to the left is going to be called a MEC, or a modified endowment contract. And so what we want to do is, obviously, no one likes paying taxes. We don't want a taxable policy. So we're going to build a policy to where it really snuggles right up next to the max amount of cash value you can stuff into it without it becoming a MEC. And that's how you would build the policy. You want to have it continue to be tax-free, just like life insurance is supposed to be. So we want to get over there, but how do we do that? Because if I was to put a mark on this timeline of just your basic old, down the street life insurance guy selling you a whole life insurance policy, it honestly would probably be like somewhere over here on this timeline, where you could put $10,000 to a whole life insurance policy premium. It would end up building cash value over time. It just takes forever for there to be any cash value. And even when it gets there, it doesn't grow very well. So that's the type of policy you hear most talking heads speak about in the first place, is this bland old basic whole life policy that's more designed on the death benefit side of the spectrum than it is for the cash value side of the spectrum. So what we'll do to get anywhere on this line, there's this new thing. I say new, it's been around for quite some time, but I mean, it was kind of created to help solve this when the MEC limit issue came on board. And that's this thing called a paid up additions rider, the PUA rider. I like to call this the cash money rider. And so that is the worst U I could have ever have drawn. Let's see if I can do. It's not really much better, but forgive me. I don't get paid for my handwriting. If I did, I would be broke. But that's our PUA rider, cash rider. So what essentially you want to do is you want to stuff a policy with as much cash value as you possibly can. So the majority of your premium, if we're going to stay at $10,000 that we're going to add to this policy, we don't want to put $10,000 just to whole life insurance. We want to put as much of it to grow cash as fast as possible, as efficiently as possible. And that's where this paid up addition rider comes in. The majority of your premium will typically be going into the paid up additions rider. So how that normally plays out is we'll take your $10,000 premium that you want to put in, and we'll put a certain amount to what's called the base premium, or just the normal whole life, and then the rest will go to the paid up addition rider. So typically you might see 3,000 or 4,000 base premium and 6,000 or 7,000 PUA or something like that, if we're just keeping things simple and not trying to go crazy with policy design. So let's just go ahead and say we're going to put $4,000 a year to the base premium, and we're going to put $6,000 a year to the paid up addition rider. And what that's going to do is bump us really close to this MEC limit, just for ease of purpose. So that's kind of how it works is you take your regular whole life policy, you take the premium you want to do, but you max out the paid up additions rider as much as you can up until you hit the MEC limit. So that's how you build a proper policy. And so what I'm going to do now is take this information. We're going to do a $10,000 premium policy. We're going to show you how that builds out. An approximate, by approximate, I mean, it is a real policy, but one of the reasons why it's difficult to share, here's what a real policy does, is because everyone's policy is different to some degree. I mean, male, female, your age, your health, all these different little things that kind of have little impacts on it. But anyway, we're just going to show just a normal individual starting this policy, what we can expect, and then how we should really see the policy in light of what else we could be doing. Let me go ahead and pull that up over here. I'm going to pull up this calculator, this illustration, and over here on the right side is where we're going to start. And so what we have here is that same type of policy I just mentioned on the timeline, where we're going to put in $10,000 a year. That's going to be split up between base and paid up additions rider, just like you normally would expect. So in this case, we have a 35-year-old. To kind of give an end timeline, we're going to go for 30 years, or until he starts out at age 35 and he ends when he finishes up his 64th year of life. So 30 years total in this timeline. And he's going to start a policy at $10,000 premium, and he's going to fund it with base and paid up addition rider premium for 5 years. And then you'll actually notice that we stop funding the paid up addition rider. We just start funding the base premium from here on out. There's a couple reasons why we do that. He could keep funding it at $10,000. One of the main reasons we like to keep our money growing as efficiently as possible on a cash flow basis. But everyone can make that decision. Sometimes it opens up some money so people can buy a policy next time on their spouse and on their children and so forth. So this is more of a personal state that we would talk to you about. But just keep in mind that we may do that with you. We may plan on talk to us, and we'll let you know kind of what our thoughts are on this. But essentially what this means is that over these 30 years, we actually, down here in the red, you'll notice we've put in a total of $150,000 in premium from age 35 to age 64. So for 30 years, we put in $150,000 of premium over this time frame. Over here, we have our cash value and our death benefit number. So here in green, we have our cash value. At the end of 30 years, we have $354,000 of cash value and $816,000 of death benefit. That's what this individual has at that period of time. Now, this doesn't show any banking, any moving of the money, all the things that we like to talk about. This is just straight funding a policy with premiums. And if you look over here on the left-hand side, you'll notice there's this information here. The internal rate of return of this policy is 4.45%. So right under 4.5% rate of return on this policy. But I think the word internal rate of return may need a definition because it's kind of a word. I mean, most people don't really hear about it. So essentially what the internal rate of return means is that it simply takes this stream of deposits, what we would call premiums here, but it just takes this stream of deposits and it says, hey, if we're going to end up with $354,000 in an account, and here's how much money we're going to put into it. This is the stream of payments we're going to put into it over these 30 years. How much interest would all of this money have to be earning every single year that we contributed to equal $354,214? And so that comes up to 4.45% of what it would have to earn every single year. But you'll notice that a policy doesn't grow in a straight line like a savings account would. We start off, we put in 10, we've only got 5,700. We start off negative, you could say, and we end up quite positive. So it's not exactly a straight line, but that's why the internal rate of return is a good calculation because it doesn't take just a single year and show you what the rate of return, quote unquote, was that year. It shows what would it have been if I had moved it. And how you can kind of prove that is if you take this rate of return and you copy it, and you go to, I slip over to this alternate account. And what I'll do is kind of clear this. I don't know what this all is. Clear this. Essentially what this does is it says, well, what if we earn that same rate of return just in a savings account or something like that? So here you'll see the same contributions each year. You'll see the end of year balance column over here. So you'll see if we earn 0% interest over that time frame, we'd have $150,000. That's just how much money we put in. But if I paste that same rate of return, 4.45% that we earned inside the policy, you'll notice, assuming it earned 4.45 every single year for that 30 years, we would end up with $354,214. So trying to just prove what I'm trying to say, that the internal rate of return is essentially the rate of return that stream of money would have to earn every single year to equal what we have in the cash value. But we do know that a policy doesn't work in a straight line. So obviously in the first few years, we're earning a lot less than 4.45% because we don't even have all the money we put in, which also means that later on in the policy, we'd actually be earning more in this case than 4.45 to make up for the fact that early on we didn't. So not a whole bunch of time to go through that. But when you're looking at 4.45%, you're like, yeah, that's pretty good. Considering we're not in the stock market, these things are guaranteed to grow. We're not really risking, the volatility factor. But we do know that, hey, this policy is growing without taxation. So I was able to have I put in 150. I've got 354,000 of cash value. That's a $200,000 profit that I made that I didn't even owe any taxes on. Well, if I did have it in a savings account or something like that, or a mutual fund or something, then a brokerage account, then I would have to be paying some taxes. So if we just put you in kind of a moderate 20% tax bracket, because I can add that in here, you'll see this number change down here. Now it says how much would I have to make in a different account to match what I had with the policy, assuming that account I'd have to pay taxes on. So when we do this, you'll notice that it would actually take 5.5% interest that you have to earn elsewhere to pay the taxes and still net $354,214 at the end of the day. Well, most of us understand pretty well that there's no savings accounts or things like that are paying 5.5%. So we'd have to go put that money at risk somewhere. We'd have to go invest it somewhere. And any time that you're investing money in something like the stock market or anywhere in between, obviously people are going to have to get paid. So if you're going to go into a mutual fund or something like that, there's probably going to be a management fee attached to that, especially if you want to have help from an advisor or actually have somebody to talk to. It's like a financial professional. So there's certainly going to be a management fee there. So, a pretty average management fee is 1%. You can see way higher than that for hedge funds and actively managed portfolios, less than that for like an index fund. But if you wanted to have a help from an advisor, you can typically expect something like a management fee of some sort, right around 1%, give or take. I could be conservative, I could be aggressive, who knows? But assuming a 1% management fee, you're now up to 6.62%. That's how much money you'd have to make somewhere else, let's say in a mutual fund, to be able to pay taxes on the gains and also cover the fees involved in doing that exact thing. But we can't just totally forsake the death benefit either. The death benefit is of real value. I mean, most people would understand that you probably shouldn't live your life with no life insurance, especially if you have a family or married or something like that. So most people would say buy term and then take the rest of the money and invest it in mutual funds or something of that nature. So if we did actually include term insurance in this picture and say, well, we're going to have to buy that because we don't end up having this death benefit here, then that's going to also impact the numbers. So what I did is I looked at the death benefit here, and I noticed that it's pretty consistently around $400,000 to $500,000 greater than our cash value, depending on the year. Approximately about $500,000 pretty consistently throughout the time here, difference between how much death benefit we have and how much cash value we have. So what I did was I took a 30-year term insurance policy with a death benefit of $500,000 to kind of match this, and that premium, assuming he's in good health and everything, would be $538 a year, or a little over, 40, probably $45 a month, something like that, for $500,000 of term insurance on a 30-year term policy. So whenever we add the fact that he's going to have to match the same benefit we're getting with the life insurance policy, or at least get close to it, he's actually going to have to earn a total of 7.25%, let's say in the market or something like that, just to match what we're getting with a whole life insurance policy that's designed correctly. But honestly, at this point, after 30 years, what happens to the term insurance? It's gone. And so, it's not even quite the same benefit, because here in this, on the whole life side, it's whole life insurance. It's going to be there until the day he dies. And so the family's going to get a lot of money because of that. So it's even not quite fully apples to apples, but it's pretty close. And so what we have here, the question that I'm curious on is it really worth, if you have to earn 7, 8, 9% in the market just to match what we're getting, is it really worth the stress? That's what I'm curious on. When I run these numbers and do these types of analysis from just my own personal life, me and my family, figuring out what we're going to do with money, it makes it difficult to say, yeah, you know what, I'm going to go jump into a mutual fund for the long term, knowing that I have to earn a pretty decent, and I'm in higher than 20% tax bracket, but knowing that I have to earn, this high of a rate of return just to match what I'm getting with the policy, I don't think it's worth the stress, and also the possibility that I don't earn that much and I would just regret it. And so that's one thing I say, but just to see, I was also curious. I was like, Nate, what if I looked back over the last 30 years in the stock market? Like, look at the Dow Jones Industrial Average or something like that, and say, well, what if I had just put money into a policy during this time, or put money into this market during that time frame, and then I would have seen this. So what I did is I pulled this up as well, kind of a market history report. And unfortunately, if you look up here on the top right, top left, I don't think I've updated this software in probably too long, because the last year that was available to me for me to look at was 2018. So I took from 1989 to 2018, which is 30 years in the market. Started up in 1989, went down through 2018 in the market. And I just took the Dow Jones Industrial Average. And I wanted to see, would I have even been better off in the market over the last 30 years? And that's what I'm starting to wonder. I don't even know if I would have. But essentially what you look at here is you'll notice there's two numbers. There's what's called an average rate of return of just a shade over 9%. And then there's an actual rate of return of just a shade over 7%. And if you've been around this for any period of time, you've heard us talk about this happening. What's the difference between an average return and an actual return? And actually, it is really important. I'm not going to go into too much detail today, but essentially what happens here is that an average rate of return just takes all of these interest rates through, they just add up all the interest rates for 30 years, The negatives subtract, positives add, and you get an end number. You divide that by 30, and it comes up with an average rate of return. But the problem is people don't experience that as we're funding money. So as we're contributing to it every single year, the actual return we're going to get is going to be weighted differently depending on the sequence of returns that you receive. So that sounds really vague, I guess. But essentially, if we just take a quick example, and then I'm going to be done talking about it. If let's say you invested $100,000 in something and it earned a 100% rate of return the first year. First off, great rate of return. Your $100,000 is now worth $200,000. You just doubled your money. You earned 100% rate of return. You got $200,000 now. We earn 100% rate of return the first year, but in year 2, we earn a negative 50% rate of return, or we lose half of our value. Well, now our $200,000 just got hit with a 50% loss. What does that bring us down to? It brings us down back to where we started. We're at $100,000 left. Our actual rate of return is 0%. We didn't earn anything. We're just right back where we started. But if you look at an average rate of return, that would take the 100% rate of return we earned the first year. It would subtract out the 50% loss of the second year. So we're left with 50%. And since we did the timeline of 2 years, we would divide the 50% by 2. And on paper, a mutual fund guy could mark it out and say, I've averaged a 25% rate of return for the last 2 years. And he'd be right. That's true. He would have averaged a 25% rate of return over the last 2 years. One 100% return, one 50% loss, your average 25%, but your actual return was 0. So what I'm trying to say is when you deal with losses, the sequence of loss can impact it. So essentially what this is saying is if I had contributed money every single year from 1989 all the way to 2018, I would have earned only 7.18% if I actually was in a mutual fund that was able to grow as well as the Dow Jones Industrial Average or something like that, or the S&P 500 would be also very close to this. But we also, for those of us who spend much time in the financial world, we know that very few mutual funds ever actually beat the market, let alone match the market, especially over a 30-year time frame. It's just so rare. So the chances that you happen to be plugged in with an advisor that found a mutual fund that was going to match or beat the market over 30 years is probably pretty slim. So when I'm looking at this, 7.18%, and I say, well, for me to be able to pay taxes on all of this, pay a guy to be my advisor and actually help me and manage it and cover term insurance, I'm thinking, man, I don't know if it's worth the chance that, I would have to earn 7.25 just to match and get 354 at the end of that time frame after paying taxes in like a brokerage account or something like that. And so when you run these numbers, you really start to question, do I need to be in the market? Do I need to be? That was the main reason I brought this up. Remember, here, Nate Scott, Living Wealth, all of us here, we're not opposed to you investing money. We really are not. In fact, we encourage it. We encourage looking for opportunities. I think we would probably say we'd like you to look for opportunities that may be outside of the volatile stock market, something more like real estate or lending or some of these other non-correlated assets, they would say. We're all for it. We really encourage it, thinking outside the box, using your imagination. But all that to be said, we're not against investing. But in fact, next week, I'm going to show you how to do it. But here today, what I wanted to at least give people some comfort. For those of you who are already doing investment banking, have these policies, just know you're really not missing out, guys. You're really not missing out. You'd have to earn a pretty darn good rate of return to be able to pay the taxes on it, be able to pay the management fees on it, cover the term insurance costs that you would have had to open if you didn't have these policies, just to match what you're getting with a policy. So you don't have to feel like you're missing out on it. For those of you who aren't in it yet and are maybe on the fence or have money in the market, just know I don't think you really need to be putting money there just to have enough to retire or whatever you want to call it. I think you're going to be doing okay regardless. However, next week, we're going to show you exactly what you should be doing if you did find opportunities. Like there are a lot of opportunities now that the stock market has gone down quite dramatically from its height due to this COVID-19 virus. So now would be a good time to say, hey, I've got these life insurance policies. They got a lot of cash flow. Maybe jumping in now could make sense. Maybe not. It's tough to time it. I don't want to encourage anyone to do something foolish. But essentially, the main gist of this webinar was to focus in and say, guys, if we can earn 7.25% after fee, after tax, all the after term insurance, all these things would be included. The question is, do we really need to be funding the stock market? Is it really worth it to you? That's the question you have to ask yourself. And that's the question that we just encourage you guys to take a look at. But with that being said, I'm actually going to wrap up today. I'm going to open it up for questions. But before I do, I just wanted to let you guys all know, maybe I can chat it out here. If you wanted to go to livingwealth.com/meeting, you can actually schedule a meeting with me or someone else. So livingwealth.com/meeting, you can go ahead and you can book a time with me if you'd like. I'd love to dive in more detailed with this with you if you want. Would love to share more information with you. If you'd like to meet with me, that's livingwealth.com/meeting. You can sign up and get a consultation with me or someone else, and we'd love to meet with you, talk more about this. But yeah, just as we're wrapping up, just understand when you look at the true power of a policy, how much it's really going to grow by tax-free after all the cost, having the death benefit, knowing that we're not having to take the same risk that everyone else is dealing with. That means you can sleep through the night pretty easily here during crises like this. In fact, you can look for opportunities to make more money with your money. And I don't think you have to regret not being in the market. Just as an encouragement to you guys that you're on the right path. And if you haven't joined us yet, there's plenty of room. There's plenty of room, and it's really fun. So with that, I will go ahead and I'll go ahead and answer some questions for those who would like questions answered. Some people I think are chatting in, and some people I think are typing in questions. So it's going to be kind of hard to bounce back, but you are right. So somebody said, add the death benefit back in and it makes the return even greater. And you're absolutely right. Yeah. I mean, if something was to actually happen to him at age 65 or 66, right after the term insurance would have ran out, then we would end up having a much higher return than what's shown here. Absolutely. So, I mean, it was kind of just a tip the iceberg, I guess, of what's actually going on in this. Another question is, any thoughts on how cash value insurance policies will be affected if we go to a cryptocurrency world? Well, that could have a whole webinar in and of itself. So, I'm not totally sure exactly what how to answer that in a very short period of time. But remember, the life insurance policy is not an investment. So if we're going to go to a cryptocurrency world and you need some cryptocurrency, what should you be doing with your policy cash values? You should probably be buying cryptocurrency with them, or whatever the case may be. So in other words, remember, we're not saying buy a policy, let money sit there for forever. Don't ever be wise about what's going on, because the policy is the only thing you'll ever need. The main gist of this webinar was, once again, these are the questions that like to come up when I do compare, which is why you don't see me compare too much, is mainly because I'm not here to say don't buy crypto or don't go into these other types of assets, don't buy these other investments. I'm just, that would bring in the banking side of the policies. How can we use them? And is there a way that I could put money into a policy, use that money to buy crypto and actually make more? And then if the dollar dies and the policies are, since they're dollar denoted assets, are just not worth anything because people are only exchanging crypto, well, I would have bought all the crypto. In other words, we want you to be doing the same things you would have otherwise done, but just change how you're buying things. I hope that makes sense. I don't have enough time to really go into it. I got one. So one question. So if I understand this right, after the 5th year when the premium goes down, then any money we put in over the new premium goes toward the PUA rider. That is correct. Yep. So if just like in this case, he was putting in $10,000 a year for 5 years, and then it dropped down to $4,000. If we were to put more money in after that, it would all once again be going to the paid up additions rider. The base premium never changes. The paid up additions rider can be increased or decreased. So it's a flexible rider. So I mean, even before then, we could have changed how much we were going to be putting in. Is there any other questions? I may not be seeing. I may not be getting to all of them. It's kind of hard. One person asked, "Is this policy an IUL? Is this policy an IUL?" No, this policy is not an index universal life insurance. That's a great question. I actually kind of meant to talk a little bit about that before I went into this. But when we talked about policy design, by the way, there's no such thing as a paid up additions rider for an IUL policy. But when you go back into policy design, I wanted to mention that not only does the policy have to be designed correctly, but it should be the right type of policy from the right type of insurance company to really match what the concept of infinite banking is teaching. So if we're going to live by principles and we're going to do the right thing when it comes to policy design, there's a couple of things that you always want it to be from a mutual company, not a stock company. So you want you to be the owner of it. And you don't want a policy tied to the market in any way, whether it's an index policy or variable policy. You just want a regular policy stuff with paid up additions riders. Another person said, is there a point where we can stop paying and still benefit? Absolutely, absolutely. In fact, for more information on that, or at least an idea of that, if you go take our free beginners course as well, that you can find that on livingwealth.com. We have a free beginners course that dives into it. You'll see examples of us with policies just like this, where we're borrowing and buying cars and paying off mortgages and doing some of the banking side of things. And if you go do that, you'll notice that in all of our examples, we stop funding the policy completely after a period of time. We don't suggest people stop funding it just for fun, because obviously we want more and more money to be built up in our bank so we can do more and more things with it. So we don't normally suggest people do that, but it certainly can be done. We asked another person asked, well, what about banking? If we were using the money, can it be even sweeter when we start recapturing money? And I think that's absolutely right. I mean, if you're using your policy to finance cars and paying yourself back with a high interest rate, or using it to make other investments like we're saying, and are able to spit out high rates of return and funnel it all back into the policy, I mean, you can really see these numbers jump up quite well. And honestly, guys, that is about all the time I have for today. I'm trying to think. We have one question: are the dividends buying additional paid-up insurance? That answer is yes to that. We have one guy ask, would it be better to put $6,000 into a new whole life policy after year 5? Yeah, great question. That answer would be yes. That answer would be yes. We would want to go ahead and we wouldn't suggest, if you're just an individual saving money, building money up, there's no reason to stop funding this policy's PUA rider unless you're actually wanting to open new policies. That's exactly right. So after the 5th year, we would expect you to want to open new policies at that time, or just keep funding the paid-up additions rider. But either way, you don't want to stop saving money or save less money. That's probably not a wise idea. Unfortunately, I guess. I mean, I see a few other questions, but I think I'm just gonna have to go. We got one last question. Somebody asked, does the base premium after the 6th year, the $4,000 after the 5th year, does it go straight to the cash value? Yeah, I mean, that's a great point. So the base premium, that just the regular whole life premium, as I mentioned when I was going through the policy design, it actually does produce cash value. It actually does grow cash value to it. If you just buy a regular whole life policy, it will build cash value. It just builds it slowly, and it takes a while for it to get going. I mean, if you looked at it for 20 or 30 years, it actually wouldn't look too bad, over 30 years necessarily, but certainly early on, it's terrible. So by year 5 or 6, that $4,000 base premium, it actually is growing really well. I mean, you can see that on the screen here. We go from $43,000 to $49,000 of cash value from year 5 to 6. So we put in $4,000 and it grew by $6,000. So that means we got all 4 back plus $2,000 of profit. We're doing pretty good. We're all hog at the trough at that point. So that's good. Some of these questions, I'm actually seeing them, but I just think they're a little too complex for me to dive into on this call. Once again, if you want to meet with me or someone to talk about some of these more in-depth questions, I'll write it out again. If you want to go to livingwealth.com/meeting, that'll just bring you to a page, livingwealth.com/meeting. You can, just write, I think, just your name and email, and it'll send me an email, and I will reach back out to you or plug in with somebody, and we'll get those questions answered. So everyone, thanks so much for joining me. It really was fun. You should all be getting an email about the webinar I'm going to do next week on Tuesday, which is going to go in depth to, it's kind of almost part 2 to this, which we're going to talk about. Okay, so we know that the policy does grow really well, and especially when you compare all things and you combine them in. But if we still want to go attempt higher rates of return and earn more, we're all for that. And we're going to show you how to do that next week. I think it's on Tuesday afternoon, same time. 3 p.m. Central Time, Tuesday. You should be getting an invite probably tomorrow or something like that to register for that event. I'm almost calling it part 2 for this one. And we are going to continue doing more of these webinars as often as we can. Some from me, some from like Ray, our founder, maybe some from Holly as well over the next few weeks, taking advantage of everyone's at home time instead of going around and, trying to do live workshops like we like to do, but weren't able to do that right now. And this call is recorded, so it should be available at some point. So I do thank you guys for coming. It was really a pleasure. Remember, livingwealth.com/meeting. If you want to speak with me, want to start a policy or want to do something like that, we'll have a consultation to talk about it. Would be happy to do so. And with that, guys, we're going to go ahead and shut it down. Once again, thank you so much for coming. If you want a little bit more information, go ahead and sign up for a meeting at livingwealth.com/meeting, or you can go to livingwealth.com and take a beginner's course, which is great, or Ray Poteet's ebook. A lot of resources we have for you. Well, God bless you guys in this crazy time. Hope to hear from you soon. Have a great day.